So in this video, we're going to get into workers' compensation. Now, workers' compensation insurance, we talked about this briefly in the last module, but it's not a tax. It is an insurance thing, but it is something you are required by law to have for your employees, and it's usually for workplace injuries. It's some insurance that if an employee is injured at work, they can file a claim with workers' comp, and they will be able to replace some of their lost earnings through time off of work, as well as covering some healthcare expenses related to that workplace injury. So we want to be making sure that we are doing all the reporting that we need to make happen for workers' comp to be accurate. Basically, what you'll do is you'll get a policy set up with a company, with an insurance company, and then every year you will have to do an audit. And they will send you all the paperwork, all the things they require. They're going to want your income statement. They're going to want your balance sheet. They're going to want your payroll journal. And they're going to want the detail of everyone who worked for you and what they did for you. And by what they did, I mean there's going to be a classification system. You have to figure out what is the workers' compensation classification of their job. And are they a split employee? Did they work 50% in the office and 50% in the warehouse? You need to keep track of that because that matters. It's the work they do changes the risk level. So if they're working in a high risk environment, you need to pay more in insurance. If they work in a low risk environment, you're going to pay less insurance. That's how it works. So there is a whole classification system of workers' comp codes that you need to be kind of generally aware of. Okay, so going through the slides here a little bit. So again, it's a workplace injury situation. That's why we need this. It's required in most states. You get coverage through private insurance companies that are state authorized. Most states have like a database or a special system where all of this information is stored. And so the insurance company has to be in that database. And then the employer pays for this. It's not something that the employee pays for at all. What you do is you pay it in advance. Most insurance is paid in advance. It's a prepay, and you prepay based on your estimated payrolls for the year. The amount that you pay depends on the job that employees are doing. So here's Green Sales Company. At the beginning of the year, the accountant computed estimated premium based on the annual estimated payroll for two different job classifications. We've got the office work and the sales work, and then the rate. Well, notice that office work is a much lower rate than sales work. Salespeople, maybe they're out in the field, maybe they're driving their vehicles. That's a lot more dangerous than being in an office, sitting down in a chair all day. So the estimated premium is then the total payrolls times those percentages, and then you get your estimated premium based off of that. All right, so then once you've got that, you would debit your prepaid insurance account. And you could have it very specifically prepaid insurance for workers' compensation. If you want to have an account for specifically workers' comp, you can certainly do that. And then you would credit your cash account when you actually write the check. Then obviously you'd need to make an adjustment each month for the amount of payroll that is expired, or rather the amount of time that is expired. Now remember, that was an estimate. That was just an estimate. So here at the end of the year, we go through our audit process and the firm's accountant calculates the exact premiums based on what we actually paid employees. We estimated that office work was going to be $182,000, but it was actually $188,000. So we were underestimating, and so we didn't pay enough. And then for sales work, we estimated $660,000, but it actually came out to be $672,000. So again, we didn't pay enough. We paid the total exact premium was $3,646.19. We paid in advance $3,573, and so there's an additional amount owed. And that's common for an audit to find that the estimate was off and that you either paid too much or you paid too little. And so if you paid too little, you're going to need to make a payment. And if you paid too much, you can apply that to next year's premium because you're still going to need insurance next year. And they will probably use the same approach where they look at your estimate of payroll. Now they've got actual payroll numbers to work off of. You can say increase that by 5%, 10%, right? You can make a determination of what you want that to look like when you're talking to your insurance agent, or they'll just do it for you, which is more common. All right, and so then the T accounts look like like this once you've gotten the difference between your actual amount paid and the audited amount. So we've already paid the $35.73. That's already been credited out of our cash account. We made that payment at the beginning of the policy term. Then we determined that we still owed $73.19 when we did our audit, and so we have a credit to the workers' comp insurance payable liability account. We're going to need to pay that $73.19. Right, that's the next step. We'll make that payment, but for now, let's book it as a liability. And then here we are also going to need to make an adjustment for the prepaid workers' comp that we had pre-recorded earlier. And so we had a balance of $3,573 in our prepaid account, what we paid in advance. So if we have not been making adjustments on a monthly or quarterly basis, then at the end of the year, let's make sure we get that adjustment. And so we make that adjustment by debiting the workers' comp insurance expense, $35.73, crediting the prepaid account, $35.73, in order to zero out that prepaid account. It's no longer prepaid. The year has expired. And then we also have that debit to the $73.19 for workers' comp insurance for the amount that we did not prepay and that we still need to make that payment. So that was the additional payroll that we had not estimated, but we found that we actually spent more on payroll than we thought. And so our workers' comp increased. So debit to the workers' comp insurance expense, credit to that insurance payable, and later on we'd make a payment where we would debit insurance payable, credit cash to relieve that. All right, so that's workers' comp. It's pretty much that is the process that you run through every single year. You need to know what are the jobs that our employees are doing, what are the classifications, what are the rates. All this stuff is Googleable. You can search for it. There is a state database for all these states where you can determine what is the rate. It changes. It's not always the same, but you need to understand the nature of the work. There's also some situations where you might need to know like whether someone is exempt or not. Sometimes the owners of the business can be exempt from workers' comp. That can be complicated, but you'll work with an insurance agent who is at that insurance company. They'll send you everything you need to know. They'll provide you with the premiums. They'll provide you with the document that says you're insured. When you have a claim, you'll contact them and they'll help you fill out that paperwork. It's not as daunting as it sounds from an accounting standpoint. You just need to know like what those policy documents look like. And when they ask for information, they're going to break down exactly what they need from you. It's usually going to include your income statement, your balance sheet, your payroll journal, detailed list of your employees, detailed list of how much you paid those employees, detail of what their job classifications are, and then they'll do a lot of the math for you. All right, so that's where I'll stop this video. In the next one, we will go over some adjustments for payroll and things that we need to cover there. All right, see you then.